Good evening and welcome to this week's episode of Sunday Night Live, your favorite automotive show where we talk about those things that improve the customer experience at your stores. Whether it's the front of the store, the back of the store, or the middle, doesn't really matter. The better everyone is at their job, the happier they are, the happier the customers are, and they come back to you for everything they need when they need it.
Mm-hmm.
And just about every week, I bring on the experts to share with you what they do or what they've done to help you get a better handle on what you do. I'm blessed with a great network of automotive professionals that span decades worth of experience. And today is no exception. I have my good buddy, Paul Machin. He's my brother from another mother. And we're going to talk about the data. It's nothing personal. It's not political. It's data.
Right.
And the data tells I always say the data tells the one story, the people tell another story, and somewhere in the middle is a good action plan that you can use to propel things forward. So welcome to the show, Paul.
Thank you, Paul. It's been a while since we've been here, but always looking forward to having a conversation with the audience. You know, you've got a great following, so your people tend to want to understand the complexities of our industry, not just at a surface level, but really deep. And I appreciate that.
Complex automotive? No way.
Mm-hmm. All right. It's not as easy as you like the car, you want to buy it. Okay, I'll sell it to you. You know, there's a whole lot more to it than just that. Used to be, but not anymore.
So for the one or two people that may not know your background, why don't you just take us down memory lane a little bit and tell us your progression, your history, so they get a feel for, who you are and why they should listen to you.
Wow. So I don't look it, I've been told, but I've been in the business now almost 33 years. I was born in it, so to speak. I had the fortunate benefit of my father in a car business. I call him GP. He raised me right in the industry. The first 10 and a half years was within the Rick Hendrick organization. Went through all of the classes and schools, graduate of Hendrick University over there. But while there, I was offered the opportunity to open the first Saturn store in the country. And back in the 90s, to talk about the process, the people and the process that needed to be put into place, because we didn't really have a lot of technology then. It was very, very early stage. I mean, AOL was dial-up, and remember America Online?
Oh,
right?
yeah.
Dial-up. It was the very beginning of that time frame. So it was people and process that we focused on. And I did that for 7.5 years underneath the Hendrick organization and was blessed to get recruited by CarMax. So I transitioned from the beginnings of using people and process. And if the technology was in place, Saturn would still be in business today. But CarMax comes along and says, we're going to do the same thing in the used car vertical. We're going to do everything that Saturn did, but now we're going to add technology to it. I'm in. Came here, opened up the 4th location in the nation, or the 5th, I should say, here in Greenville, South Carolina. 5 years later, I had the opportunity to become a small equity partner in a Nissan store, trying to apply the people, process, and technologies that I learned between Saturn and CarMax in the Nissan store. Did that for about right at 2 years, maybe 2.5 years. Found out that unless you're a 51% owner, you really can't make a lot of change. So I got recruited to Dealer Track, very early days of dealer, point number 54 in the field in sales. And so Dealer Track back then, people are like, what's Dealer Track?
Wait a minute, employee number what?
54. Yeah, 54. So I most of my career, I was the first, one of the first to raise my hand and say, that's different, that's new, I want to be a part of it. A disruptor, right? And that was basically what I learned. Who I was later was I liked doing things so different from everyone else that, why not? Let's try it. And if I could be more successful, I did. So Dealer Track, almost 12.5 years there. Then did a small startup in Vegas. Did that, got out right at 2.5 years when we were able to liquidate and get out. And then I had the blessing of being invited to Black Book Data and Analytics. And the best way I can explain what data and analytics Black Book is, you want a toy, but in order to make the toy work, you got to buy the battery, right? You can buy cheap batteries and you might get a limited life out of that toy. And then you got to replace it over and over and over again. Or you can buy the most expensive battery, high quality battery, and that toy will run, way longer than anything you've ever anticipated. So the battery powers the toy, so you get the benefits out of it. That's what Black Book data and analytics is. We are the battery that powers the majority of a lot of the technologies in the marketplace today that serves the fintech industry, the automotive industry, the investment community, the insurance community, the fleet rental remarketing community, the auction facilities. When you really think about what we power with our data, and what makes it work for me is I'm able to take my background and all of my experience and interpret this data to where it's relevant to you and I, or to our
That's
business.
the key.
That's the key. And that's the key.
What's in it for them? Yeah.
There's a lot of meetings like, okay, I see all this data. All right, I got to translate that to make sense to my clients and my partners, because it's really good data, right? It's really good data.
And you guys do power sports too, I see, right?
Power sports is in the last couple of years. So power sports accelerated, right, in the last couple of years. And when we talk about power sports, let's specialty vehicles. We're talking about RVs, motorcycles, ATVs, jet boats, power boats, classic cars, muscle cars, ultra exotic cars. We call all of those specialty vehicles. We have the most robust data set that's on it. But when you get into that class category, it's like art, right? Classic art. And I didn't know this until I came here, that there's the top 10 investment instruments outside of stocks, gold, and silver. There's a classification, art, wine, bourbon now is one of those. You want to guess what the number one investment vehicle that you could use if you had the money to be able to get an incredible ROI on? You want to guess what that is? Any classic car.
Oh my God. Yeah. The stuff that's I'm watching the market on that.
Yep.
Crazy. 50, 60, 80, $120.
I'm in the process of restoring my 2004 Audi A4. It's a 2004 Audi A4 Quattro with a 3-liter V6. It's British racing green with the Dove tan leather interior. Essentially, everything's still original. Needs a new
S line.
What's that again?
Is it an S line?
Oh, it's before they came out with the S line. This is 2005. This model is 2005. And so this year it becomes a classic. And so I've got people coming out the woodworks. It's at the shop, and the guy's calling me like twice a week. I got a buyer here. I'm like, nope, not interested. Got a buyer here, not interested, because they see the same thing I see. It's going to cost me $5 to $10 grand to recondition it, but it'll be worth 40, 50, 60 grand when I'm done.
They're looking for an ICO, Paul.
Yep.
All right, let's get to a couple of comments here. We have first on the scene, Ty Thompson, our ATI buddy. Says Paul Machin with a rocket ship emoji, and my good friend Jen Sanford. I'm happy to be here, but can't stay long. Getting ready for a big week. It's the Paulie Squared show. And we got Jared Kalfas, speaking of Black Book, tuning in. Been looking forward to this. Lots of knowledge and great discussion to be shared. So much going on economically and industry-wise. Here. And Michael Larkin, good evening all. Hey, Paul and Paul.
Mikey, Jared, good to hear from you guys. Yes.
And my fixed ops retention brother, Joe Clementi. Good evening, gents. And Ryan Baum. Hello, everyone. All right, let's jump right in, man.
All right. So so the first portion is my rising tide insight. So I just want to clarify that, right? So I'm not going to go through Black Book data per se just yet. I got to build the case about the raging times that are ahead. And I want the audience to understand that the news I'm going to share, although if you have one mindset, if your cup is always half empty, then it might be somber. But if you got a half full mindset, this is fantastic news. And in order for us to take advantage of what's coming to us, we have to understand the opportunity and the why we have the opportunity, right? We got to understand, okay, here's the opportunity. Why do I have it? And what's happening? And so when you can understand those three things and become prepared, oh my God, it's incredible before us. I'm predicting that the next 3 to 4 years will be the greatest subprime boom we've experienced since they've been recording and tracking subprime finance. Do I need to say that again? I mean, that's powerful, what I just said, right? In the next
huge.
oh yeah, huge. Some of my best partners and clients I work with are so excited about what's coming. And it's kind of a catch-22. In order for this to happen, something else has to happen, right?
Yeah.
Someone has to fail in order for others to succeed. So let me back up here. I go on a level set. On October 30th, 2008, the 110th Congress, second session, I will provide this link for your team. The U.S. public is mad about a system where gains and profits are privatized while losses are socialized. Essentially, it became law. It became law that when banks fail, we step in as taxpayers and prop them up. It's been happening, let's see, since I can remember. Do you remember that savings and loan crash in the late 80s and early 90s?
Mm-hmm.
Right? I was a bank. Every crash that we've had since then has been preceded by the financial institutions, bankers, essentially. And I take a moment to say this because not one crash that we've ever been through is because of the automotive industry, the greatest business in America, in my opinion. Not one has been preceded by failure of the automotive industry. Does that make sense?
We're bigger than U.S. Steel.
Right? So precedence is made. That happened in 2008. So now we begin to understand, what happened with SVB back in the summer. I warned about that, right? See, people were freaking out. Oh my God, we're gonna lose all our money. No, we're not. We're not.
In the blink of an eye, it's over.
Yeah, and everybody who had savings and investments that were worth $250,000 plus were made whole, right? Because the people who were connected to people who knew people lobbied them and said, you're going to bail us out. Now we have that precedence. We have that precedence. And that's the key word. We have precedence. Fact, never in the history of the Fed have they ever raised interest rates so much, so fast. And I can provide that link to everyone. Now, right now, the ratio of the 10-year yield to the 2-year yield curves in the U.S. Treasury has been inverted for several months, since mid-2022. And an inverted yield for decades has historically been a strong indicator of a likely recession. Okay, I'm not trying to bum everyone out. I'm just talking about if you are prepared and you know what's coming and you can do the things today, you need to do these things today so that when the market flips, your community, your people know that you are the dealer to go to, right? The New York Fed recession probability model suggests a 56% likelihood of a recession by September 2024. So what I'm about to share in the stories, we're going to go through the news first, because within the news are nuggets of gold if you know how to use it, right?
Right.
If you're entrepreneurial minded and you're an innovation driver, you're going to get excited. You will, right? So this is the 110th Congress. I have just proven to you that this has been in effect for decades. So we have precedents. So whatever bad news we hear, how horrible it's going to be, we're going to have a bumpy ride, right? It's going to be a roller coaster, right? So what do we do? How do we make sure we're ready? Well, let's listen to what people say.
Yeah.
The yield curve, 61%. This is what's next for the U.S. economy, 2024 projections. This data came specifically from the New York Fed and was put in this beautiful graph that you see here. I did not put it together, but I can put
I didn't put it up yet. So.
Oh.
Oh, was I supposed to have that screen up, Paul?
Yeah. You weren't sharing the screens.
Oh, yeah. Hold on a second. Listen, I've been traveling so much, Paul. I get on the elevator. Right now, I'm in, where am I? I'm in Buffalo, New York. Okay. hence
You're in
no
zombie mode.
background. I get in the elevator this morning and I'm pushing the button and it's not working. I'm like, what the hell is up with this elevator? So the door opens up. I'm about to go to the front desk to complain. And the guy, he's got a Hilton Garden shirt on. So do you work here? He says, yeah. The elevator's not working. I'm pushing a button here. It's not going. He says, what floor are you on? I said, I'm on the 17th floor. Well, no, there's no rooms on the 17th floor. Those are offices. No, I'm telling you, I'm on the 17th floor. Like, oh, wait a minute. No, that was 2 hotels ago. I was on the 17th floor. I'm actually on the 14th floor.
Yep.
And I pushed that, it worked again. So, oh my God. All
I've
right.
done it myself. I really have. So I understand.
Right. Hold on one second here. Marshall Sheldon has a question. He says, no HD. What's that? What's no HD? I'm not sure what he's talking about. Oh, I'm on my laptop in Buffalo. So it's as remote as remote gets. All right. I'm bringing this back up on the screen here. How far do you want to go back, Paulie?
I'm just going to, for the benefit of the audience, I have the link here. If you want to go back and read what the 110th Congress second session on October 30th, 2008 put in place. In a nutshell, profits are privatized while losses are socialized. The only thing I would like to add to that, and I think we should, is we all should get a profit sharing check from these businesses that are taking advantage of using us to help them socialize their losses. That's all I'm going to ask for, right? So, but I have the link for that. Now,
I don't think we're going to get the money, Paul.
Well, it's all we got to do is ask. You get 100% of what you don't ask for, right? So, who thinks we're going to have a recession within 2024? Well, obviously, the Fed is going to tell you 0% likelihood. The yield curve, which has been a solid indicator for decades, 61%, yes. Economists are saying 48%. And that's about right? Depending on who the economists you listen to. One says rosy, one says, not so rosy. You've got to use your own, you and I were talking about this earlier, discernment, right? You've got to be able to have enough ability to read, ingest the information, take that data and overlay it on your own personal life experience and say, you know what, I agree or disagree with what I'm hearing and seeing. That's the power of using information and having discernment. So we're saying 48% of the economists are saying we're going to have a recession. 69% of the consumers that were surveyed, absolutely, we're going to have a recession. Main Street, right? 15% Goldman Sachs said no. Guess who else said we're not going to have a recession? They're no longer around. They were one of the longest serving investment companies in the world, Bear Stearns. Remember that? Pre-2008? No longer in business, but they said the same thing. We're not going to have a recession. Bank of America says 35 to 40%. Now get this. CEOs, the C-suite, 84%. What do they know? What do they know? What information, what data do they have that we don't have access to that they see that's going to impact their company? Well, the first thing is they have their own financials. And most companies have debt. They've leveraged debt to build and grow their business, right? And if they've leveraged debt, that means they've got to start making payments on that debt. And some of these companies used debt as a way to keep their profits going and really don't have the profits to offset their debt. And the bills coming due, that's one of the reasons why it's so high. But the number 2 reason why they said 84% is they're listening to their people. Their surveys of their own employees are telling them they're having a hard time living day to day. Right?
Hold on one second, Paul. All right. Marshall Sheldon says heavy duty, not high definition. He's in the heavy duty space.
Well, I got that information too for you, Mark, if you want it.
And then Jennifer says, when was this survey done?
I'll put the link in it for you. This was like 2 weeks ago. It was produced.
Oh, okay. So it's fresh.
Yeah, very fresh.
Fresh as fresh gets.
Yeah, very fresh. So I decided to do some digging, right? I have a personal experience with this where I have been to the grocery store several times and I have seen families walking around telling their children, don't touch that, we can't afford this, don't get that, we can't afford this. And some are emotionally distressed. Grocery shopping has been very emotionally distressing for them because they couldn't afford what they needed to buy, because how much more it's gone. The reality is we've been trying to find, all right, what is an average statistic? So the brutal reality of today's economy, a statistic that Mark Zandi, chief economist of Moody's Analytics, after doing a lot of research, he's estimating that the average American pre-pandemic to today is paying $734 more each month for the same bucket of goods and services that they used to pay for 2 years ago. So there's been no improvement, right? It just costs more to do the same thing. On average, $734 more dollars, roughly $8,800 a year, right? I don't know about you, but I don't have a lot of family and friends that can lay their hands on an extra $9,000 just laying around. I can provide the links to anyone in your audience that wants it, right? This article talks about how new car prices hit a record high. We know that, how it's happened. We also know how financially stressed millions of Americans are. Right now, between 30 and 40 million college graduates started paying their first student loan payment this month. And they're already struggling, right? They're already struggling. And it's opportunity for those of us who are prepared and ready, not so much for those who are not prepared. So how bad is it? Or what kind of opportunity we have? Well, this is the first time since the Fed was created, 13 years. They booked $100 billion in losses. And this is the Fed we're talking about. They went ahead and booked losses. So if the Fed is booking losses and they set monetary policy, if they're losing money, then who are we to trust? Here's what we got to trust. You and me. How we know we do business every day. I can't control what the government's going to do. You can't control what the supply chain's going to do. We can't control what the finance industry is going to do as far as lending and advances, right? We can't control none of that crap. But what we can control is our business, which means in order to understand our business, we got to look at what's happening, why it happened, and what can we do to change it in the future, right? And this is part of what we need to understand. You could be an ostrich and stick your hand in the sand and hope it turns out better, but it's not going to happen. To give you an idea of how tenuous, we're walking a tightrope right now. This is from the Fed, right? U.S. Fed. This is called liquidity and credit facilities loans. They call this the BTFP program, Bank Term Funding Program. And it updates once a week. Right now, from March 15th through September the 27th, they are now on a weekly basis, short-term lending, $107 billion to mid to regional sized banks. Essentially what this means is it's an overdraft protection. That's the best way I can explain it. It's an overdraft for mid-sized to small regional banks out there. And it went from zero, because it started in March of 2023, to now it's an average of $107 billion a week. That was as of September 27th. You can go to this report, download the link, and follow it yourself on a weekly basis, which tells you that there is financial struggles within the lenders that's in the marketplace. Doesn't mean we don't get panicked. That means get prepared. Do your research. Understand why this is happening so that you can have the right inventory, the right finance partners, and the right training in place to take care of our customers.
I want to jump in here. A couple of things.
Sure.
For one, I don't know if you can read the comments or not.
Oh, I haven't seen it yet. I can't read the comments and pay attention to what I'm doing.
Mark Rodriguez says, the way Paul fine dines on a daily basis, you wouldn't know we are headed for trouble. Oh my God. All right. So a couple of things, right? So to an earlier point, we're spending a lot more for the same stuff.
Right.
There are things that we have to buy. We have to buy gas, right? We have to buy groceries.
That's right.
And while at the same time, those prices are high, or were high, they were a lot higher companies were posting record profits. I mean, beyond what they ever made before. So, we could dissect that piece of it many different ways, right?
Mm-hmm.
Somebody's gas budget is a big part of their budget, just like food. So that's one thing that I want everybody to kind of have an open mind on. The other thing is with the lending, and I'm a little bit at a loss here regarding the lending, because a 700 2 years ago is not a 700 today.
Correct. That's
right.
correct.
And I've heard all this stuff about the banks tightening their criteria.
That's right.
Right. But I don't necessarily see that. I learned of a case recently where this high school kid got put to sleep on a payment that was about 85% of his net income for 6 years. So how does that even get approved? A high school kid. We're not even talking about somebody out of school working full time. We're talking about a high school kid that got put to sleep.
Auto approval. I can tell you right now, auto approval. The kid, his application ticked all the right word tracks and everything was checked off just right, that the algorithm gave the approval, not a person.
85% of the net monthly income.
Yep. Absolutely. Wow. I've seen it.
Crazy. I didn't want to get off track, but I just wanted to interject that.
It's all good stuff, right? So I've been talking about consumer-backed, commercial-backed mortgages since the beginning of SVB, right? Actually, way before that, I've been talking about the risk in the marketplace because of the move to work from home and how the value of commercial real estate is really taking a hard hit. And so many of these investors of commercial backed mortgages took advantage of the incredibly low interest rates and high appreciation values and took out massive loans and then with a delayed debt payment. And now they got to pay the debt back at the new rate, whatever that rate is today. And so the majority of the lenders that we've seen fail, we've seen 6 already that we know of, and there have been many more that have been under the radar, have been due to the failure of their commercial mortgage-backed assets, which when you have that kind of money as a lender going out the back door, you've got to make restrictions in other areas to offset that loss. And I'm going to go into that in a little bit, but Bank of America just had their bond rating slashed on their commercial mortgages. So if you want to really get a sense of what's happening to the retail industry, it's because I was raised and I was taught, as I told you, my father in car business says, watch the real estate market, because what usually happens there is between 4 and 6 months, and it's a trickle down effect in the automotive industry. So
yeah, they go hand in hand.
Yeah, they go hand in hand. I mean, every time a new community went up and that was anywhere near my stores, I made best friends with those real estate agents in that whole community. And I sold probably 80% of the inventory that went into those new garages within 3 to 6 months after purchase of the new home. So it's just a really good strategy. I just gave it away for free. If you feel good, your audience, anyone wants to, Venmo me some cash, you can. I'll be glad for that tip. I'm kidding.
Don't forget to put your handle on there.
Right. So I had to put this in here because I had a couple of my old school buddies were ribbing me. Hey, we just saw we saw CarMax and we saw the report. Their used car sales sunk. I'm like, okay, what did it sink to? And they're like, it just said it sunk. I said, it sunk about 7.5%. Now let me ask you a question. Do you know what the overall used vehicle industry's loss in sales was? Right at 7%. So CarMax is in line with the rest of the industry, give or take. And by themselves, they own 3 to 5%, based on how you count their sales. 3 to 5% of the entire used vehicle industry. One company. I mean, and I'm gonna really give some emphasis on the power of big, right? And why we need to pay attention to that. Now, my last thing before we get into the real data that I want to share with you is I wanted to get an understanding of what's available in the marketplace today. Now, I could use my information, my retail market insights, but I felt it was more significant because any dealer, anybody can sit right now Go to autotrader.com and do the same exercise. 75% of the American population, $400 is where their car payment where they want their payment to be, is what they realistically can afford, right? So I wanted to do a research, right? I did just earlier today. How many vehicles within the nation that fit a $400 payment, 10% down, because most people have 10% down. You figure tax, tag, title, and whatever fees, it's roughly 10% of the purchase price. And we talked about earlier, 750 prime credit score, right? And you can see right here, look at this. $2,277 down on a $22,000, $770 used car. I got to finance that thing for 6.4% for 60 months. Now, you and I just finished talking about pre-pandemic, 700 was a great beacon score. If you were still a 7, you're not a 700 today. If you kept everything,
you're subprime,
right, or near prime, right, because your debt leverage, because you've been using too much debt, right? So who's going to qualify for 6.4%? I heard an analyst the other day was talking about the way the OEs are making these super expensive new cars, which is also driving up the pricing of pre-owned cars. We're still above $27,000 for the average pre-owned car. It's way more than $400 a month. So we've priced out 75% of our community. Now look at this. To the left-hand side of 22.7, you see it says 112,000 miles, 63,000 miles. I wish I had the S, but most of these vehicles were older than 3 years of age and had more than an average of 15,000 miles a year. What lender today will finance that car for 60 months with only 10% down at 6.4%? Common sense, understanding, right? Understanding everything I just shared with you, what's happening in the markets, what's happening in the financial industry, what's impacting our people every day, our community, and how can we best get prepared for it? And I've been saying it since day one. Let's dive into the nuts and bolts. Wholesale weekly price changes, right? So as you can see, the gray dotted line here, that's the wholesale changes, right? So now you see the dip, right? It's starting to dip, right? And that's, we felt like the UAW, right? The strike is still in place, and we're finding out that they're asking for, I think the union is asking for biting off more than what the big three can possibly offer today. One thing for sure,
that's going to go for a while now.
Yeah, well,
it sounds like they're digging in deeper.
Yeah, they're prepared to go 5 to 6 months if necessary. But it's not the automotive dealer I'm worried about right now. We are already feeling the impact of the strike on the partner providers to the manufacturers, the part suppliers, the chemical suppliers, any material supplier to the manufacturer is impacted. And then now think about that domino effect. The automotive industry touches every single industry in the world. And that domino effect, when it starts to spider web out, it's like that little tiny pebble, and that little ripple crosses the whole ocean. That's what we're talking about. That's the real impact. We have union workers impacting the lives of non-union workers globally right now, asking for things that I think is too far stretched. And that's my personal opinion. What we're seeing is the values of the vehicles right now, they're continuing to decline in the wholesale lane, but the rate of decline is in line with typical seasonality. So it's not outrageous, the decline we're seeing. Matter of fact, in my personal opinion, I think we're going to start to see our used vehicle values go up, and I'll build that case for you here in a second. Retail listings, right? Now, let me set this, make sure the audience knows. We watch about 98% of all independents and franchise dealerships websites every single day. Paulie, we record every VIN, every VDP, and we track it. We know when prices were changed, was the description changed, because we want to make sure that we understand the real-time market price. We're as close to the stock market as you can get when it comes to real-time values, because we update our retail pricings every day. So what we're seeing is retail listings, they have not dropped as aggressively as wholesale has. And in my opinion, dealers are hoping to hold the line, because if you've got a 45-day-old 45-day-old car right now in inventory, you way overpaid,
Yeah.
in July. In July, right? Now, Chase and Bank of America. Now, get this. Just recently, look at us. We just made huge gains in the auto finance world. Like they did something special. They didn't do crap. All they had to do was hold the line. You know why? Because Citizens, Bank of Montreal, Fifth Third Bank, US Bank, Capital One Bank, and hundreds of other mid-sized and regional banks, all of them either pulled out of the automotive vertical or cut back on their loan to value advance, called the left-handed turn down. You know what that is, right?
Left-handed turn down. Talk to
Yeah.
me.
Of course, I'll let Paul Meijer buy a vehicle if he's got
Oh,
10.
yeah.
Now I can say, hey, I've been approving your loans. You're not strong enough to close it. That's called a left-handed turn down.
Right.
So the banks can walk away saying that. But there's been dozens upon dozens upon dozens of these mid-sized to smaller regional banks. And the banks I just named, those 5, they're not small, right? Those banks are not small. But those are the ones we know of that have openly said, we're either out of the auto lending or we're cutting way back. And guess who picks up the leftovers? Chase and Bank of America. You know why? How could they advance more? How could they stay in business to do more? Because they're counting on the precedence that's been set. When the failure comes, profits are privatized, losses are socialized.
How
That's
underwater do you think a lot of dealers' inventories are right now?
My average last week was over 4.5 million. 450,000. I did 7 different analysis for dealer groups, and it was about 450 grand. In 1 week.
Wow.
Right. So here's the key. We're not talking about the loan to value, right? So during the pandemic, dealers were asking for, on a 3-year-old used vehicle with 60,000 miles, they were asking for way more than what the car sold for brand new and wanted to finance it for more than what it sold for brand new. New cars were selling for way over sticker, and many of them still are today, right? So that loan to value advance, who pays for that? And how does that impact our margin, our ability to make a profit? And you've heard me say this before, but I've been talking about negative margin compressions coming. It's been in the market, and I've been asking, pay attention to these data points, because as we get squeezed, we got to get better in other areas, right?
Right.
So the difference between the average wholesale price in January 2020 versus the average listed retail price in January 2020 was $7,500. In January 2022, the difference between the average wholesale price, which incredibly spiked, but the retail price also spiked, but not as much, dropped to, so the margin spread was $5,275 versus $7,500. Now, obviously, that doesn't include the acquisition costs, transportation costs, reconditioning costs, insurance, marketing spend, commissions, all that stuff that goes into eating up that margin, right?
I was going to say, because then the margins are, what I'm seeing in the market, it's quite a bit less than that.
Oh, absolutely, because you got to take all that out. This is just pure net, right?
Right.
What the average transaction wholesale price was, what the average retail transaction price was. And that gap was $5,275 in January 2022. As of September the 1st, 2023, because we had a drop in wholesale valuations and dealers are holding the line retail wise, we're back to 6,975 on that compression, on the retail margin spread. So what we're seeing, however, is a lack of quality 0 to 3-year-old inventory that dealers can take advantage of in the market, right? And you know that my top 3 things I say, how is a dealer, how do they go in and change their community to say, I'm the place, I'm the dealer that is here to help service you? So since the very beginning, 100% service appraisal on every auto that comes in the service department. 100%, no ifs, ands, or buts. I had someone tell me, it's Easy to implement, difficult to keep it going. Okay, then change your process.
Right. They make it difficult to keep it
Correct.
going
Right.
because
Identify what those keywords are.
once you have a process, it's a question of holding people accountable and following that process.
Right. And number two, been telling dealers, create your own We Buy Cars portal. Or if you're a SaaS provider, create that for the dealer. Help the dealer find ways to alternatively source inventory. I've had friends, and you've had friends too, they've been going to all these conferences this last summer, over the summer and fall right now. And the number 1 and 2 topics are, I need to find better quality cars. I need to find ways to get more inventory because I can't find these kinds of cars in the lane anymore. They're just not running through. And if they do run through, it's like a great white shark feeding frenzy. And then you overpay for that car. I don't want to do that. There are 3 lanes a dealer, every single dealer owns, and they don't spend enough money and time owning it. It's the service drive. That's a lane. It's the retail front line on their lot. That's another lane. And the online lane. They do a half-ass job on all 3. Right? Go ahead.
You know what I'm saying also?
What's that?
So not only are they paying stupid money for these cars,
Mm-hmm.
but some of these cars are coming through questionable, right?
Whoa, huge.
Let me tell you questionable, okay? A car that is one butt scratch away from total loss, having a Carfax that says minor damage on it. And when you look at their glossary, minor damage, scratches.
Mm-hmm.
I'm talking literally
What,
1 millimeter from total
Why
loss.
do you think that is, though, Paul? Why do you think that is?
Man, I don't even want to go off on that tangent today.
Well, the reason is they can't find the kind of quality car they want to find, and they're trying to make the margin that they can't get it elsewhere. True story. I got a neighbor who's looking for a particular type of a BMW. We found over 2 dozen of them, and I would say 75% of what we found, all of them were salvage title, but being listed at a full retail comparison.
That's even crazy.
Yes. Yes. Until the consumer finds out about it. And the sad thing is I've had to communicate that to the dealers. And I've like, look, I have a fiduciary responsibility to you as my dealer. I need to talk to the GM or the dealer. Do you know this is what's going on? Do you know the liability you have on that? And help them understand what they need to do. And then sometimes they change, sometimes they don't. But those are the actors that really make our business difficult to work with.
Right.
Working. Now, electric vehicles, right? I find this incredible, right? Because I've yet to hear anybody talk about this.
The volatility?
What's that again?
You're talking about the volatility and the pricing?
No, the opportunity we have. And the opportunity to take advantage of that starts in January 2024 will only be to a select few dealers who make sure that they have developed the people, the process, and the technology to outbuy more than their fair share of available pre-owned electric vehicles that qualify. Okay, so what you see right here, all right, the blue line,
yeah,
that's
hybrid electric.
Yep, hybrid electric. The red line right here, plug-in hybrid electric, and the green, all electric, right? So that's roughly 470,000 all EV.
Yeah.
And then the hybrid electric, right? 800,000. Beginning in January this year, remember Cash for Clunkers?
Yeah.
We got a kind of similar type of program. So a consumer can now go to any dealer that has a current year model back to 3, right? So 2021, 2022 to 2023, electric vehicle, hybrid vehicle, plug-in hybrid electric vehicle, and a fuel cell vehicle. Those 4, if they meet all the right requirements, also the consumer has to meet the right requirements, can now, at the time of purchase, can sign over a form to the dealer to use that up to $4,000 in tax credit as a down payment. Now let's go back.
On a used car.
On a used EV. On a used EV, right? So everyone's promoting, oh, we gotta make EVs, EVs this, EVs that. The reality is most electric vehicles are still unaffordable to 75% of the population, whether it's new or pre-owned. And I just did this an hour before our call. I wanted to see from my zip code. So this is Auto Trader, and I challenge everyone to do this every single day. Look at your zip code, do the whole freaking nation, 2021 to 2023. How many pre-owned electric vehicles? And you got to do $26,000 because remember, if you can get up to $4,000 back in as a down payment, and you want to keep the payment at $400 a month with 10% down. How many of these EVs are in the market? As of today, this search I just did, 3,000. Paul, 3,000 in the whole nation on Auto Trader.
A lot.
No.
It's nothing.
So it's not a lot, right? But you know what? If I have the right kind of team and they're well trained, I got a buying team that knows how to call you, because you've got one of those 2021, 22, 23, 4 categories, all EV, plug-in hybrid electric vehicle, fuel cell vehicle. You got one of those cars, I'm calling you. 1-800 Paul, how you doing, Paul? You're going to be my best freaking friend because I'm going to buy that car from you. I'll send someone to go ship it. Cost me $300 to $500 to ship it from anywhere in the country to where my dealer is. And I want my unfair share of this inventory that the government is going to give $4,000 as down payment to. But who's talking about?
And that store is going to crush it.
Correct. That one store or group, if they do it right today, they got to do it now. They got to build it now. They got to build the market presence now. So when it happens in January, they're not playing catch up. Makes sense?
But on the flip side, there's been a lot of volatility in the pricing with the new car pricing dropping. Look at what Tesla's done. Those are some major drops there. There are also dealers afraid to buy cars because they don't know when the other shoe is going to drop. And they're afraid to spend 10 G's more than maybe they have to.
That's a great question, and I have an answer for you. This is the low availability of returning used vehicles, right? Now, this slide shows the new vehicle sales and lease penetration by calendar year.
Yeah.
And you goes all the way back to 2000. And it's easy to see in years of high new vehicle sales. 3 years later, we have high used vehicle sales of 0 to 3-year-old used cars. Make sense? You follow me?
Yeah.
Right? We did not sell enough new vehicles in the last 3 years to support the demand of 0 to 3-year-old inventory for the next 3 years. That comes back in through natural process. And when I say natural, trade-ins, lease returns, fleet vehicles, off-lease vehicles, rental returns. Because during the pandemic, the manufacturers did not supply fleets and rental car companies with new cars.
Right, which in turn screwed the used car market because when they were normally thinking of turning their cars, they were keeping them longer. So the cars coming out of those rental fleets, a lot higher mileage.
Absolutely. What I think is so cool is that you and I have been talking about this challenge for over 3 years. And it's just now becoming a serious topic for people to understand. This graph right here goes out to 2027. What we're saying right now is that we're not going to be able to meet the available demand of 0 to 3-year-old inventory through normal sourcing channels. Let me say that again. We will not be able to meet the demand of available 0 to 3-year-old model inventory through normal sourcing channels. So if you're a dealer that's been listening to what I've been saying for the last 3 years on your show, you've trained your people. You have a whole network of buyers, top down, front to back. They can go out and use either a proprietary app that you've designed using Black Book data or using one of Black Book partners, because the power to buy, Paul, it's in the palm of your hand.
Yeah.
It doesn't belong to 1, 2, or 3 people. And that's the pinch point. That is the problem dealers have, is they're so stuck in 100 years ago that the used car manager is the only man in the world that put the right number on a car.
Well, what I've been saying for several years now, if a store's got 100 employees, we're talking about giving them access to software. That's it.
Yeah.
Nobody's giving them an open. Oh, well, we just lost Paul there for a second. Nobody's giving that employee a pen and a checkbook. Nobody. We're talking about teaching all of your employees how to input data. Okay. They all have their tribes of people that like them and trust them. People talk about real estate. They talk about cars. They talk about sex. Those are common things that people talk about. So you can train all of your employees. Is back. You hit the wrong button, man.
I did. I was trying to not share the screen anymore, and I ended up leaving the studio.
Now, what I was saying is, yes, they're going to need to get better. It can't just be the used car manager buying the cars. I've been talking about for years, empower all of your employees. It's an app. Teach them how to scan a barcode, how to take pictures of damage, and load it into the app so that a team of buyers can look at that and compare it to the buy list as to what they need. Hey, if I have a circle of friends and family that trust and like me,
Right.
the likelihood of them listening to me say, hey, you know what? This car is on our hot list. Can you come in this afternoon or tomorrow morning? Is a lot greater chance than them seeing some little ad somewhere that dealers spend tens of thousands of dollars on to get maybe 1.5% to 3%, and everybody's clapping their hands at a 3% return. Right?
That's right.
We have to, as you say so eloquently, don't think out of the box. Throw the box away.
Throw it away.
Right? Throw the box away.
Throw that sucker out. And so you can hear my excitement, right? I have been engaging with, I got to be careful, several new types of startups that are coming to the marketplace that are really trying to put the power to buy in the palm of the hand, answering all the questions that dealers are concerned with. Well, what about, what about the real condition of the vehicle? My used car manager is the only one who can eyeball a car and tell me if it's been totaled or not.
Please. The right training, the right quality. Decades ago, I'm buying cars sight unseen over the phone with a confirmation. I'm not just telling them it's not a blank check. And I'm coming within a nickel by asking the right questions. Back then, I'm coming within a nickel of what it is. And by the time I look at it and I educate the customer on the tires, on the body condition, on that check engine light they weren't thinking about, it was not a problem. There were some cars I picked up money on. A lot of them.
A lot, right? There's a lot. So
I
think it's Edmunds. God, I read so many things. I think it was Edmunds that put out a report. They are estimating that the average dealer today on every transaction, 45% of the time has a trade.
Yeah.
When I was running my stores, I better be trading for 70+%. Right? What happened to the other, what's that? 20%? What happened? Where'd it go? CarMax and Carvana. Right now, 80, if you read their 10K investment reports that they are required by law to put out, about 80% of their inventory is sourced through alternative channels. But what did they do? What did they do? I'm going back to, you got to understand the market, why it's happening, and what can you do to get in front of it, right? They started building the community first. They trained everyone in their organization, everyone in a CarMax location, top down, front to back, can make a buy bid on a car now. And put it, hey, I know you, Paul, let's go to CarMax.com. There's your check writing number for your car.
And you know what? They've made themselves a verb.
Yes.
Even dealers are telling their own customers, sometimes we can't give you that, but if you take it to CarMax, they'll give you that, and we'll pick you up.
It's called the max. The verb is they'll get you the max, right? I'm like, if they can do it, we can do it too, right? We can do it too. I met Fred from FedEx. He's one of the founders of FedEx at a conference he did. I'm dating myself, in the early 2000s. I'll never forget what he said. He goes, Shit. I walked into a crowded vertical in overnight delivery, right? It was crowded back then. He goes, I asked for 45% more money. And now, you know, my company name is The Verb. They walk into a UPS store and say, I need to FedEx something.
Yeah. You got to love that.
Yeah. 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 But that's what a dealer needs to do to build their community. If they do the things now and get ready now and train their people now for what's coming, when it hits, it's no shell shock. I'm ready. Everyone knows what they need to do, how to do it, when to do it. And if they can't do it, there's a backup in place to follow. Kind of like that military training I went through. Everyone knew everyone's role, everyone's job. So if one fell, someone else could step right in and just keep it going.
You know, I had the pleasure of spending a couple of days in Jacksonville, Florida, and St. Augustine. I went to Ed Roberts' book signing, and I met so many of the people that worked there. And what struck me was, well, a few things actually struck me. The fact that everybody was so incredibly happy to be there. That's number one. So that speaks well for what their customer retention is. Because I know he said they doubled their, he had a problem. They doubled their turnover. I think they're at like 1%. It was crazy. But the other takeaway was that people started and worked their way through. Okay. So I'll be talking to one employee that's an advisor that did 3 or 4 different roles in that store. And what I heard over and over from different employees was that, I'm sorry I was so much of a you-know-what to you because I never really fully understood what you did. And now that I'm doing that job, I have a better understanding of it.
Yeah. Yeah.
So
and you and I,
right? In the blink of an eye, everything's, the shit's going to hit the fan. But if we're prepared for it 2-3 years down the road and we're the leader, as you say, everybody else is going to be like this. What's going on over there?
Yeah, I was talking to one of my GM buddies of a Cadillac store in North Central Ohio. He hasn't he hasn't had the need to go buy extra inventory because he trades for majority of his inventory or he buys it from his community. But he started this program over 4 years ago, right? So he built it, got the people trained right. The community is now conditioned. You want to sell a car directly without worrying about, go to this dealer.
Yeah.
What we've been talking about, right? We have to be the agent of change in our glass kingdom. And I don't see that enough right now. I got into doing what I'm doing because I'm a dealer advocate. I believe in the dealer community. Prior to the crash of 2008, there was roughly 21,000 some odd franchise dealers in the nation. By 2012, there was less than 16,200 franchise dealers in the nation. I mean, think about that, right? 21,000 to now 16,000. That's how many dealers we lost, franchise dealerships we lost.
Almost 20%.
Right. So my fear, if we don't reach enough and really convince enough that this coming crash, right now we're at just under 17,000 franchise rooftops. We might even lose more. In my hometown, this one dealer group is buying up everybody. So it's like he's going to own the whole town. It's the larger groups are going to buy out the smaller groups because they did the right things in the beginning.
And seeing that happening for the last few years. More and more.
Absolutely.
Wow. I can't believe it, man. This hour has come.
We talked about a lot of things. I hope that there was, the audience found value into it. I don't know how to cover, make it sound sweeter than what it is. It is what it is, right? It's how we can find the opportunity out of what's there. And that's what we got to do.
For anybody watching live or watching it on the replay, if you're not connected to Paul or myself, by all means, reach out. We're always looking to connect with like-minded professionals. If we can help you or you can help us, then there's a good reason to connect.
Yes.
Well, thank you very much for sharing the info. Always love talking shop with you, my friend.
Love it too, brother. You have a good evening.
And to those out there, I hope you have a safe and successful next week. And we'll see you next week on Sunday Night Live. Thanks for watching.